If Bitcoin dropped and it went down to $20, let's say this index here went down to $20, you would still only lose a little over $400. And because it dropped so much, that's the most you will lose going forward. Even though you will stay in the trade, you will be in it for the next week and the following week and so forth until you get your monies back. But the most you would lose over that time, if you structured the collar the way we teach here at Dorian Trader, that's the most you should lose, even if it dropped a ton. And some of you didn't believe that fact until you had this collar strategy on back in April when we had that Liberation Day. The collar strategy to me is the perfect strategy in this uncertain market of we could go down a lot, we could go up a lot, all this news that's going on. The collar will allow you to sleep at night and still outperform. And if you're doing it on something like this BITX, I'm going to jump over to BITX. This is the 2x Bitcoin ETF. This is a ETF that has robust options because they have weeklies and not just weekly. Most options or underlinings or stocks that have weeklies, they have robust options, but that's not all. In this case, this Bitcoin ETF has robust options and they have weekly and it gives a monthly dividend. And so the goal is if Bitcoin is going up 100%, I'm just using that as an example, then this should be up 200%. It should be up 2 times the Bitcoin performance. Obviously, if Bitcoin is dropping, and then it should be down potentially 2 times what Bitcoin is down. So it's a double-edged sword, right? You have to play both sides. And so let's use this to talk about a strategy that I like to say, you can forget the news. This strategy works no matter what. I'm kind of calling this that type of title because we've been bombarded with news recently. Right? We've had a ton of news since the November election, and it's only persisted. And it's affected trading in a positive way, and it's effective trading in a negative way. And it's definitely has created more unknowns, more uncertainty. So if you are a short-term trader, it's made it a lot more challenging. And if you are a long-term trader, it's made at least your 6 month viewpoint a little more muggy and made you a lot more nervous, especially when the overall market was down 20% in April. Yes, it's come back fast. At the time of us talking about this, it's come back fast, but it's always going to be times where maybe I shouldn't say always, but it's going to be periods of times in the future that you're going to have this uncertainty. You're going to have these clouds, and you're going to be uncertain that if the market's going to go up in a decent way or go down in a decent way. And you don't want to miss out on that up potential, and you don't want to experience that down potential, right? It sounds like, you want your cake and ice cream as well, right? You want all things to be rosy. And if you can structure it that way, that, okay, if the market goes up, I'm going to benefit. If the market goes down, I'm going to not experience, that huge market drop. With options, you have the ability to structure things that way. Okay. You have the ability to literally structure things that way. You can do something like being a buyer, right? You can be a buyer of an option and define your risk. You can buy a single put and be bearish, and the most you will lose is that money you paid for that put. You can buy a single call and be bullish, and the most you will lose once again is that amount you paid for that call. You can do the put spread, you can do the call spread, and it's all defined. But if you do it that way, you have what is called time decay against you. When you are a buyer of an option, you have to get the direction right. And you have to get the direction right in a big enough manner for you to win, because time is always a force against the buyer. Before we continue with the video, I just want to quickly point out, if you need any additional help, please consider joining our trading club. You can do that by clicking on the link in the description area, and you'll get a 3-month trial for a flat fee of $60. We look forward to seeing you in the trading club. Back to the video. You can be right directionally as a buyer and still lose money because the amount you paid supersedes the move, that directional move that you were betting on. Even though it went in that direction, that direction you were betting on, the amount you paid for that ability or that right was too much. So to me, that defines your downside, but it doesn't give me that ability to use time as my ally in a significant manner, to allow time to play that I never have to realize, or if I didn't want to, I never have to realize a loss. I can let that situation play out because I understand that if I'm doing this type of concept that I'm going to explain here in a second on an index like the S&P 500, that the whole time the S&P has been around, the whole time the Dow has been around, this, over 100 years, it always comes back after every drop, after a 50% drop, after a 70% drop. It comes back. And historically, over time, it has risen. So if I can understand that fact, I can already have a probabilistic edge just by structuring my trades based on that fact, taking advantage of the market having the tendency to drift up. And it's going to do that into perpetuity, you guys, until something significantly changes and we don't use markets anymore. Right? Maybe AI, I don't know what the future is going to be, but it's not going to be in our lifetimes, it's not going to be in our kids' lifetimes. The markets are going to be there. It's no mechanism that's ever been created that provides the type of capital markets do. All of the richest people in the world are attached to the markets. Their wealth are attached to these markets. They don't. Elon Musk is worth, I don't know how much he's worth now, but I just say 200 billion. I don't know, right? I haven't checked recently, but I just say 200 billion. He doesn't have 200 billion sitting in the bank. It's not liquid. He might not even have $1 billion sitting in the bank that's liquid. I doubt he has that much liquid. Straight out cash, I'm talking about. If you ever watched Judge Judy, I forget how she used to say it. It's something cash money or something she used to say, right? So I was listening to a interview with Mr. Beast, and he was saying, it's the interview guy was saying, you're worth a billion dollars, and Mr. Beast said, yeah, probably, but it's not like I have $1 billion. I got less than $1 million in my bank. And so I'm making this point for you to understand that the markets create wealth, and the markets are going to continue to go up over time. We're going to have periods where we're down 20, 50, 70%, literally, and we've had that in the past, and we'll have it again. But that doesn't mean it won't recover. It will recover. And so that's your edge already, right? But what if you could add something to that improves that concept already? You already have that edge, that time, right? Just that whole concept of something a lot of advisors, preach out there because they're asset gatherers, right? Meaning that they want to have billions and trillions of dollars on the assets because they're getting some percentage of that money. That's how they make money. They're not making money off, trading your money and giving you a percentage of the profits they make. They make money off just having your money in the account. And so the investment world has been built on that. All the hedge funds, for the most part, are like that. Asset gatherers. All the private equity firms, asset gatherers. All these mutual funds out there, asset gatherers. They want as many assets under management as possible. But they're using that concept of just put your money here, forget about it. Over time, it's going to grow. Okay. And if it's in an S&P 500 index, something like that, they're correct. It's going to grow, right? You're going to be average, and maybe you're okay with being average. But what I'm saying is that that's great, and it's probably great for most, but it's obviously not great for us on this call because we want to be traders. We want to control our destiny more. And so options allow you to improve on that concept. It allows you to improve on that concept. So I've been talking about the mugginess of, things can go up a lot, go down a lot. Well, for me, the collar strategy is that perfect strategy in that type of environment where it's so much ambiguity that you feel like you just want to close your eyes and wake up later in the future and maybe all this ambiguity, uncertainty, mugginess, craziness has ended. But what if you can do a strategy like the collar strategy that allows you to outperform to the upside the market and then outperform to the downside the market, meaning that if the market is down 20%, say you're only down 10%. When the market is up 20%, you're up 20 plus percent. You have significantly outperformed because you didn't drop 20%. So you're not gaining monies back from being down 20%. You're gaining back from only being down 10%. Obviously, if you can avoid being down, period, that's what you want to do. But I'm not articulating that. You're going to have some down periods. That is, and if I was, you should run from me because I'm a charlatan. You're going to have some down periods, regardless of what strategy you do. But if those down periods can be insignificant and it can outperform, do better than the market, then over time, you're not going to be average. If person A puts their money in a Vanguard S&P ETF or mutual fund and it goes up, 100% over the next 10 years, and person B puts their money in a Vanguard ETF, but they marry it with a strategy like the collar strategy, and over that next 10 years, they're up 200% because they had less drawdowns. Their drawdowns were a lot significantly smaller because of that collar strategy that they used. Here at the Dorian Trade, we put that collar strategy, we wrap it into what we call the safeguard strategy, what we consider is a better wheel. We didn't make a new wheel. We didn't make a whole nother, kind of universe. We just improved on the wheel. You had the wooden wheel. We now have the rubber wheel. Okay. That's the safeguard strategy. Is it perfect? No. Nothing's perfect, unfortunately, but you can make it as close as perfect as possible with this safeguard strategy. Now, the collar strategy, if you're going to use it on the Bitcoin, you would go over to this. I just say we were going to do a weekly strategy on this, right? Because you have this bug, you have this I want short-term trading kind of bug, and if you do, you're not the only one. The super majority of the people that's trading in these markets today, at least retail traders, are doing short-term type of trades. That's just the fact, you guys. So, but do you have to be like the majority of people? No, but you might have that desire to have short or faster gratification. And the markets have created themselves to facilitate that now. They position themselves to do that. When I was trading, you couldn't do this kind of stuff. You couldn't do this. Options when I first started trading, options were the shortest time frame was 30 days. Some of you guys remember the shortest time frame were quarters when options came out. They literally only expired once a quarter. Weeklies are still fairly new, and weeklies like a daily type of expiration is even newer. So, but that's the golden age. That's the golden period of making money is right now. And if you were going to do a collar strategy, and this is more of a kind of a 10,000 view kind of motivational type of talk that we're doing right now. So I'm not going to go over all the details of the collar strategy. I'm going to do this fast, and then we're going to move on. But the color strategy is doing a covered call. If you don't know what a covered call is, then you got obviously a little bit more studying to do, but that's fine. We all have studying to do. But a collar strategy is taking a covered call, and as just say we were going to sell the covered call at this 57 strike. You take the monies that you receive, some of the monies that you receive, let's say it's $99, and you buy a put. So let's say we decided we were going to buy this put at the 49 strike. So in this example here, over the next week, you can make $377 or you can lose $420. You're going to receive $22 in credit. The most you can lose on this BITX, this Bitcoin 2 times ETF, in the next 7 days is a little over $400. If Bitcoin went to zero, you would lose a little over $400. If Bitcoin dropped and it went down to $20, let's say this index here went down to $20, you would still only lose a little over $400. And because it dropped so much, that's the most you will lose going forward. Even though you will stay in the trade, you will be in it for the next week and the following week and so forth until you get your monies back. But the most you would lose over that time, if you structured the collar the way we teach here at Dorian Trader, that's the most you should lose, even if it dropped a ton. And some of you didn't believe that fact until you had this collar strategy on back in April when we had that Liberation Day. Things dropped a ton, but you capped your losses and it stayed that way even though things continue to drop. And now you're back. A number of you are back to not only even, but you're positive. Just like our safeguard strategy here in this account. Because of this collar strategy, you can do a tight collar, you can do a wide collar. But what you're doing is limiting your downside and letting the upside basically take care of themselves. You're not going to have a runaway up market. The collar will protect you to the downside so you won't have a runaway down period, or you have less losses than the average person who's just doing that Vanguard ETF or Vanguard mutual fund. The collar strategy to me is the perfect strategy in this uncertain market of we could go down a lot, we could go up a lot, all this news that's going on. The collar will allow you to sleep at night and still outperform. And if you're doing it on something like this BITX that's giving you a monthly dividend and the options are robust, that is sweet because you're manufacturing your own, or I call it manufacturing your own dividend, or creating a synthetic dividend each week anyway. In this case, you would get, I like to try to get at least 25 cents each week if I'm going to do this strategy, this collar strategy on a weekly basis. So that over a 4 week period, a 28-day period, I collected $1. I manufactured, I created a synthetic dividend. And if I had the shares, this Bitcoin ETF is giving me some more money because it gives me a dividend as well. It's about collecting that money. It's an income strategy, also a growth strategy, protecting your principal and growing over time, outperforming the market. In this case, we're going to consider the market Bitcoin, and it's really associated with the overall market now, anyway, in my opinion. But if you want to call it a crypto market, Bitcoin is that's gold standard. So the collar strategy, I want you to learn it. I want you to break it down. I want you to study all the aspects of it. And if you didn't want to adjust, you don't have to, but if you learn how to adjust it, it will make the strategy even more powerful. But it's not adjusting like a 0DT trade or a 1DT trade or something like that. Just understanding when to move your options. But that's another talk.